Today, after the RBA's latest, what next? Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and product news with a distinctively Australian flavour. I'm joined by Peter from Mozo. Hi, Peter.
Hey, Martin. Great to see you again.
Thanks for coming back on. And we were saying, gee, these months come round very quickly with all these decisions. But I wanted to get your reaction to the RBA, 25 basis points yesterday, pretty much as a lot of people expected. But also, of course, the governor's speech overnight in Hobart was also saying more rates still ahead.
Yeah, so now we're up to 275 basis points increase in the cash rate since May. That's quite a lot to squash into a 6-month-odd period. But yeah, the latest inflation figure surprised to the upside. So, I think the only question going into yesterday's RBA meeting would have been whether it was 25 basis points or 50. So they went with the 25, but definitely signaled that there are more rate increases ahead. So I wouldn't be surprised to see another 20 basis point increase in December. The RBA doesn't meet in January, so we probably get a month off from rate increases. But they've made it really clear that the inflation figure plus some other factors are really heavily influencing what they're doing at the moment, and that they're not going to slow down until they see some results from their actions.
And I guess that begs the question then, the cumulative impact of all these rate rises on households, particularly with mortgages, it's getting pretty serious now, isn't it?
Yeah, on an $800,000 mortgage, which isn't terribly unusual, unfortunately, that's somewhere around $1,000 a month on repayments that people have to find extra. And, I think for most households, that would be a serious adjustment to their budgets. Probably a lot of households do have buffers, as the RBA has been keen to point out over the last 6 months. But there will also be plenty of people who don't have that much wriggle room. Perhaps their financial situation has changed. They may have gone through or be going through a period of unemployment. The people in that kind of situation, that $1,000 is, it means the world to them. So, yeah, it's a pretty tough pill to swallow. And, the RBA has acknowledged that in most brief statement and said, yep, some people will be doing it tough. But, they also said that they don't think that they've got any choice but to tackle inflation quite aggressively. And the interest rate tool is the main tool that they have to do that.
And it's worth reflecting on the 8.4% non-discretionary inflation, which came out in the last set of numbers too. So not only are households having to find more for the mortgage, but they're also having to find more for the stuff you got to buy as well. So, household budgets are getting crunched wherever you look.
Yeah, and not every household has a mortgage, so those households will still be feeling some pain as well. Probably not to the same extent as mortgage holders, although renters are also getting slammed at the moment. So, it's a huge segment of the population really having to adjust their finances right now.
And I thought the other interesting observation from what the Reserve Bank said, that they expect inflation now to peak at 8%. So that's higher than came out in the last budget papers. I'm getting a sense of, it's probably going to be higher for longer. Because it looks to me as though this inflationary stuff is getting more sort of sticky, and therefore, whilst we might see some elements coming back down, this could actually be a significant problem. And in fact, they're saying now, look, 2023 rates will be above their target. The inflation target will still be higher. That means rates will be higher. And even in 2024, they're still saying could be above. So it's a long journey now.
Yeah, what we're expecting might last for sort of 6 or 12 months as inflation came and washed through the system, as the effects of the pandemic resolved. There are some more intransigent factors that are not showing any signs of resolving, particularly energy, which, affects pretty much every part of our lives these days. And there seems to be no, decisive action coming from the government to address that issue. So, yes, it does now look like we're in for a period of higher inflation, and that means higher rates.
I suppose the only bit of good news amongst all of the gloom is that refinancing is still there, and the banks are actually, well, for some types of borrowers particularly, they really are very desperate to go get a refinance, and they're offering you cash and all sorts of things to try and get you to refinance to them.
Yeah, well, the main game in town for the banks right now is refinancing. New loan volumes are going down quite rapidly, so all they can do is try to steal customers from each other. And it's really interesting, as you say, there are plenty of cashback offers around, although I really do caution people to look at the interest rate that comes with getting that kind of loan and make sure that the rate itself is still competitive, because a few $1,000s in cashback can be so quickly eaten up by being on an uncompetitive rate. So, yeah, need to look at the full picture there. The other thing I was looking at was, where are the best variable rates at the moment for home loans? And, the best rates are around 4%, and there are plenty of options under 4.5%. But if you're looking at where we were 6 months ago, the best variable rate was actually 1.79%. Now, that's incredibly low. But if you look at that compared with the current best of 4%, that's an increase of only 220 basis points. So compared with the 275 of an RBA cash rate increase, if you've stuck with the same lender over that period and gone up by 275 basis points, there are loans out there that are not increasing as much. And it's a lot of those new customer offers, particularly for people with a lower LVR. So if you're under 80% and you're an owner-occupier or even some investor rates, they have not gone up as much across all lenders. So it really reinforces the need to know what rate you're on. Haggle with your current lender if you find that you're paying more than you should be, and be prepared to switch, because that can save you so much money in 6 months or a year. It could be one of the best investments you ever make.
Yeah, so we always say this, the old apathy tax. So it's time to check that mortgage rate again. And it's also worth, I think, reiterating what you just said, that just because a bank will give you, $3,000 or $4,000 to come across, if their rate is not as competitive as the best in the market, you're going to not win. You'll be feeling good for a month or two, but then suddenly you're still paying more. So it is important to look at the whole deal rather than just the splash of cash.
Yeah, and the banks do like to make it particularly attractive and throw lots of money at it, but it's often the banks with the not so good rates that have some of the better deals out there. So approach with care, but some of them can be worthwhile.
And that's why it's good and important to look at some of the comparative sites like Mozo and see what the rates are actually doing, because of course they're moving around a bit too as well. So it's keep your finger on the pulse there. I think other observation, of course, is we've got more people now whose fixed rate mortgages are going to come to an end over the next little while, and that's the other dramatic shock that is yet to come through the system. And we know there's quite a lot of those fixed rates will now get reset, and will get reset at a much higher rate.
Yeah, a lot of those fixed rates were not much more than 2%. So people having to find a new rate option now could be looking at a very steep and sudden jump. The best fixed rates at the moment, if people wanted to fix again, you're looking at around over 4% for even just a 1 year fix, and up around 5.5% for the best 5 year rates. And most rates are far above those. So yeah, I would think that most people will be rolling on to those variable rates and looking at least a 4.5%. And that's a sharp rate if they hunt around.
Yeah, that's right. So again, check. And I also think it's important for people to plan ahead, right? So if they know that their mortgage rate is going to effectively get reset and significantly up in 2 to 3 months or whenever it is, or in the new year, start planning now, start thinking about now how you're going to handle that, right? Rather than just waiting for the shock, because it's going to be a big one.
Yeah, get your documentation ready. It'll make it easier when you do need to start, reapplying, refinancing, whatever it is you need to do. Just have a plan so that you can deal with it when the time comes.
And one of the interesting observations that I see in my surveys is that some of the refinancing deals that are there include further equity withdrawal. So people are actually pulling money out and essentially paying off other debts, or alleviating their cash flow in the short term. I guess I'd be interested in your observation there. Do you think pulling equity out in this part of the cycle makes sense, or not?
Oh, look, it really depends where you're at and what your financial situation is. If you've got something like a credit card debt, of course it makes sense to pull money out at home loan rates. Credit cards are, usually 20% or even more. So if you can fund that debt and cover it with a even 4.5% loan, then it's worth doing. But you have to be careful that 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 money's going to be added to your total loan debt. It'll be repaid over 25 years. So if you do repay it over that period, you'll be up for a lot more interest payment in total, even though it's a much smaller monthly repayment now. So again, it really pays to do your sums, make sure you know what you're getting into.
Yeah, indeed. And I would also say that if you are going to pay off those credit card debts, think about the behavior that created those debts in the first place, and maybe change your behavior a bit so you don't end up with the same problem again in just a few months' time.
Yeah, it's easy to fall into old habits, particularly when finances are tight. But yeah, those credit cards can really add up quickly. And while we're talking about credit cards, most months, I think we say that there haven't been many changes to credit card interest rates. Last month, we did see a pretty big move from American Express. They have a lot of cards, particularly rewards cards, that are appealing to a lot of people. And they increased the rates on most of their rewards cards by 125 basis points to 21.99%. So that's a pretty steep rate, even compared with similar cards. And one of their more basic cards had a 200 basis point increase on its rate, 16.99. So yeah, starting to see some pressure building in the credit card sector as well.
And not in a good way, unfortunately, with even higher rates.
Yeah.
Now, before we get off mortgages, finally, there's two other questions I have. That there is talk about banks now considering extending the term of mortgages up to 40 years. And another conversation that a couple of mortgage brokers relayed to me was that the banks are thinking, well, extend the life of the loan, but then actually pay the loan down from your superannuation so you can draw down out of super to pay the capital off later. What's your thought on those two phenomenon? And is that a good thing or a bad thing, do you think?
Look, I hadn't heard that discussion, but anytime a 40-year loan comes up, I get concerned. The only winner out of such an arrangement is the bank. They will massively increase the amount of interest. And even if there is a plan to repay the loan sooner, it is so easy to say, oh, that plan didn't work out, but fortunately I've got this 40-year option, so I'm going to use that. So I think it's a win for the banks if they can make that happen, but probably not the best for borrowers. And the question of using super to fund any kind of home purchase is an interesting one, and I think it really depends on the individual situation. If you're if you're in your 20s or something and you want to use a bit of super to help get a deposit together or something, it's probably not a big deal because you've got plenty of working life left to rebuild that super balance and get yourself set up for retirement. And if you've got a roof over your head, then that will help you throughout your life, including retirement. So yeah, it's really tricky. I guess my view at the moment is that using some of your super to fund a home purchase in some way is not a bad thing, particularly because of the way that asset will be treated when you get to retirement. I'm not sure I agree with the 40-year idea, but the super idea, I'm leaning towards agreeing with.
That's quite interesting. I mean, I think at the early stages, I tend to agree, but I think if you're getting down the track and basically your superannuation pot's got quite big because you've had time in the market, the thought of suddenly taking a big slice of that superannuation pot out to repay the mortgage could actually get you into a difficult financial situation later, because then you might be having to fall back on the government pension scheme rather than your own private savings. So in a way, you could say, well, is the bank actually then, actually using the superannuation system to help repay their loan, right? That could be a problem.
Yeah, absolutely. That's a risk. But there's also a situation where you may not have been able to buy a home until later in life and have some super built up. And, I think in that situation, it's probably better to, if you could access your super, just because if you don't, you might be forced to use that superannuation to be paying rent through your retirement and not getting pension. So you're getting hit from both sides. So it really depends on the individual situation.
But all the research shows that those people who don't have a property as part of their life journey as they move into retirement phase are considerably worse off, because they have to pay a lot more in retirement for somewhere to live, particularly through rent. And of course, we know rents are going through the roof at the moment. So it is an important sort of element. And I always say to people, there's no generally right or wrong thing to do, but it's worth thinking about it carefully rather than just jumping in, and saying, well, whoopee, another 40-year, duration, or whoopee, I'll better use my super. There's always pros and cons that's worth understanding, I think.
Yeah, and it's so complicated. There are so many factors to consider. I think it's a situation where, getting some solid financial and tax advice is definitely recommended and worthwhile.
Yeah, great point. Absolutely right. There are a whole bunch of rules and regulations, what you can and what you can't do. So it's not as simple as many people would want it to be. Now, before we finish, I must talk to you about term deposits, because there's some really interesting stuff going on in term deposit world. Everybody suddenly seemed to be fighting to get those term deposit rates up a bit.
Yeah, it's incredible. Last month we saw each of the big four banks making really big increases to many of their term deposit rate options. They're still not particularly competitive rates, and I wouldn't be recommending them to anyone. But it is interesting that, for particularly 2 and 3 year options, we saw some of the big banks increasing their term deposit rates by around 170 basis points. And that was a pretty common increase for them. So, it's a huge jump. There are still much better options than what they're offering. For 1 year, you can get up to 4.2%. 2 years around 4.5%, and it sort of scales up to 5 years at 4.95%. So we haven't breached the 5% mark yet, but there are a couple of banks that are being really competitive in this space. And I'm thinking of Judo Bank and AMP in particular. It's kind of amusing. The team that I work with updates a database of banking products, including interest rates, every day. And we see, Judo Bank will come through with some increases. and then AMP will come through with some increases that trump judo by just a little bit, and then judo might match those AMP rates. So there's this constant battle going on between those two in particular. But then others are starting to step in as well and go, okay, we're missing out on those deposits because we're not being competitive. So it's kind of dragging the rest of the market up with it. You know, the rates that we're talking about are still far under the inflation rate. So, you know, if you look at it on a net basis, you're going backwards. But if you want something that's going to look after your capital and give you the best return available, some of these rates are really good at the moment. You know, it'll be interesting to see if there's a point in the next few months where they start to turn down and some of the longer term rates start to ease back. But right now, the pressure is all upwards. But the rates are, in the most part, going up fairly slowly right now. So I think what's out there is probably as good as we're going to get for a while.
Yeah, it's very interesting watching the battle and tussle between the various the banks and what they do. Of course, in comparison to financing their loan book from international sources, for example, it's actually much more advantageous to them to go the deposit route now because of the international exchange rate differences and also the rates overseas, so that you can understand a little bit why they're doing it. And it's fascinating to me in my surveys that I still see a lot of people who do hold quite large amounts of cash in the banking system, but actually don't earn anything at all on the cash that's sitting in the banking system. So, you know, my sort of query always is, well, if you're going to hold money in the banking system, at least hold it somewhere where you can get some return and alleviate that inflation pressure a little, because it's, you know, money for old rope. But again, a lot of people find it too hard to seek those deals out. But these days, with the portals to be able to find the best rates, and then the transfers and the account opening pretty much all online and relatively quick, there should be no reason why you can't make a little bit on those balances that you hold.
Yeah, look, and even if you're not wanting to lock your money into a term deposit, there are at-call savings rates that are, you know, around 4%. They're becoming reasonably common, and some of the conditions on those accounts can be tough, but then there are others that have easier conditions. So, you know, it's pretty easy to get at least 3.5% as an at-call rate. And that means that you've got the money available to do whatever you want with, like buy a house. So, yeah, you don't have to go the term deposit route, although you can get a bit more that way.
But I suppose the other point is that you can't necessarily assume that what you thought was a good rate then is still a good rate now. So you've still got to do a little bit of rate monitoring and, you know, pulse checking to make sure that they haven't done the old trick of attracting you with a really good rate and then sort of diluting the benefit over time. The banks would never do that, would they?
I've seen that so many times. A new account launches with a fantastic rate, and over a year or two, it gets eroded. You know, it doesn't increase as much as their other product interest rates do, and you can suddenly find that you're right out of the market and you need to change to another account completely. So, yeah, definitely something to keep an eye on. It's that loyalty tax that we talk about with home loans. It applies to those savings rates as well.
Yeah, unfortunately it does. It's the way the system works. So, you know, the simple choice, do you want the banks to make money out of you, or do you want to make money out of the banks? Well, you know, the choice is yours, but unfortunately it does take a little bit of effort. But the point is the amount of effort really is quite low these days because the information's there at your fingertips. It's just a matter of, one, being aware of what's going on, and two, making sure that the rates you've got are, are appropriate for the cycle of where we are, because nobody quite knows where rates are going to go. But as we said at the start, probably higher for longer than a lot of people expected. Inflation's going to stay higher, so therefore getting the maximum return you can out of any money that you've got in the system makes a lot of sense, doesn't it?
Yeah, it's so important, and it all adds up really quickly. If you look at 12 months from now, you'll have even more money in your account, including the interest you've earned, and then you can earn interest on that. So, yeah, make sure that you're getting the best rate you can all the time.
Yeah, compounding is quite helpful in that situation. Peter, I really appreciate your time today, as always, and I'll look forward to picking up the conversation probably in a month's time. I'm sure the RBA will be doing a little bit more tweaking at that stage, and I'm sure there'll be more to talk about with regard to the rates. Thank you very much for your time today.
Thanks, Mark.